Far more fossil fuels are owned in public markets than we can possibly use. That became the financial risk, that the system would be destabilized by the trillions still invested in coal, oil and gas, and ultimately by climate catastrophe would destabilize the financial system. What I'm absolutely against is this idea that you take this resource, which has taken hundreds of thousands of years to be created, and then you just put a match to it and it's gone. People will look at the last 50 years and they go, well, we've destroyed this extraordinarily valuable resource by burning it, and also potentially destroying the planet along the same way. This is the death knell of the fossil fuel industry. It's just a matter of timing now. And the investors today want to know, when do we see oil demand falling? What are the oil companies doing? What's happening with coal? The whole of the economics of this is what the investors want to know. We should have started this 25, 30 years ago, but we got down some dead ends. But now we've got the technologies in place. We just need to scale. I think globally, the investment in fossils last year was just under $1 trillion, but renewables was over $2 trillion. It's a race against time.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Mark, it's really nice meeting you. Thanks for coming on the show with me today.
Thanks a lot, Scott. It's a pleasure to be with you today.
You're recognized as one of the most influential voices in sustainable finance. You've moved billions of dollars away from fossil fuels, arguably more than almost anyone else on the planet. But your story doesn't start there in London. You were born to an Italian immigrant family in England. Can you describe where you grew up and what was your childhood like, and how did your parents' immigrant experience shape your perspective on opportunity and risk?
My father's Italian, and he came over to London in the 50s, and which was, a difficult time just after the war. He'd come from a rural family. So this is, the end of the Second World War. Him and his brothers, 3 families moved to Australia, 2 families moved to London, and my father and his brother worked in the music industry and in the, in the restaurant trade in Soho. And my father continued in music for his, his professional life, and so did his brother, my uncle Franco. Today, if you're born into an immigrant family, you'd speak your local language, you speak Italian, whatever. But in the 60s, I was born in the early 60s. Social workers would kind of come around and say, you've got to integrate. You can't speak the Italian language. You've got to speak English, which was, a tough time, particularly for my father. I had such a happy childhood, Scott. I mean, everything was new, for the family, and it was a wonderful place to be. It was a happy time. My brothers were great fun. We had a pretty much an idyllic childhood, and all these trips back to southern Italy. My dad would drive the car sometimes over the Alps to save the cost of going under the Alps, and would drive down to Rimini where there's a beach, and would stay there. We had family and friends, and then all the way down south to the family village. And it's a trip I still do now. When I'd still dream about coming into the village, going to where my grandmother used to live, all those kinds of things. It sticks with you. So I became an Italian citizen. I was born an English citizen, but I became an Italian citizen a couple of years ago along with my kids. And because I probably identify as European. And I've got this unusual surname, Campanale, which if you look at in one way, it means, something to do with bells and bell towers. But if you put the "le" in front of Campanale, the Campagna bit, it almost means like people of the land. So my family, they were producing olives and almonds. We had these fields of beautiful olive trees. And, this interest I've got in environment and nature and climate, I think some of this is almost genetic, Scott. I don't know what your genes are telling you about your ancestry, but my probably generations of hundreds of years of people working on the land every day. And it seeps through your genes. Here I am in London with another, big, busy city, but I've always had this passion for nature and forests and landscapes and so on. I probably got it from my father and my grandfather.
Your father and grandfather originally were farmers?
Yeah.
Did they lose the farms, or why the immigration to England?
So my father and my grandfather, they would be in one room divided by a curtain that didn't own their own place. The women and the girls on one side, the guys and the boys on the other side. And my grandfather would get up at 5 a.m. with his cart and his dog and his horse and go out into the fields to work. And you've seen these pictures of what are called truly houses. We had a truly house on the corner of one of the fields, which is this stone, like a stone igloo. And he would sleep in that during the heat of the day. And he was a sharecropper, so he worked on other people's land for the share of the crops. And then I remember as a boy when it would be harvest time to harvest the olives and shaking the olives of the tree and collecting it. And then the almonds would dry in the sun. And then my father would have me and my brothers and my grandfather breaking open the almonds shells with a little mallet and a hammer stone. And you'd then dry the almonds, and that would be their cash crop for the year. So yeah, they did all of that. Now, unfortunately, my grandfather, he couldn't read or write. My father left school at the age of 11, like a lot of people did at that time. And so he died intestate. He hadn't written a will. So they filed like inheritance tax on the land. And so most of the land went to pay an inheritance tax. It was one of those funny things they do in southern Italy because it was a bit of a scam. It was agricultural land, but because the land was very close to the village, as soon as the people who bought it got it, they converted it to building land, building permission. And so if you go back to the village now, they bought it for a few $1,000s an acre. And there are now huge buildings and houses on it because, of course, the village has got bigger. So that was our inheritance gone. My father gave me my little bit, and I spent my share on a skiing trip to Italy, which was, if you're going about building memories, but I wish we'd hung on to at least one field, at least one. Yeah.
What was the impetus to the move from Italy to England?
Like, I think Italian families wanting to leave a very poor part of Italy, southern Italy. My father, my mother, who I should say is English, met my mother who's English, and he came to London to be with her, and I'm the result.
Did he meet her in England or in Italy?
Well, they met in Italy. My mother followed him around a little bit as he did his military service. It was a great romance. In fact, you can get the book, Scott. You've got to read the book. There's a website called ciaomario.co.uk. I think that's the website. And you can read the romantic story of how they met and grew up, all their little kind of run-ins with various people. Like, my father's full of funny stories. Like, to leave the village, you didn't apply for a passport at the local council. You applied to the bishop. You applied to the bishop in the nearest city, and then the bishop would decide whether you would get a passport or not. Because my father was not a regular attendee at mass, the bishop said that he would not be able to have a passport. And without a passport, he couldn't come to England to marry my mother. And so he had to do a few kind of wheeler dealings with various other people to be able to secure himself his passport. If you tell people these stories, like going, what?
So there's a website, ciaomario.co.uk, that has, a biography or the stories of your family, or what is it?
Yeah, it has. My father wrote this book he had a neighbor type it up, and then he self-published it. All the people he then went on to meet.
That's extraordinary. Now, if I understood you right, though, when he got to England, absolutely wasn't a farmer. He was a musician.
My father had 2 or 3 brothers, Peppino, who played the double bass, Enzo, who played the guitar, and then Franco, who played the saxophone, and my father, Mario, was the singer. And they used to put the double bass on the top of one of those stretch limos you see in movies from the 1930s, and they would drive around the villages. They were the entertainment. They were the band. And then my father and his brother Franco then went on to open a club in Naples. Some guy had a club and they went to run it for a while. My uncle ends up touring with Chet Baker in the 60s around Italy. So he played with some great people.
I suppose if he was touring around, he wasn't home a lot, right?
There weren't many books in the house. It was a simple life, nothing to refer to. Though my mother did pick up a copy of Macaulay's The Layers of Rome or something. Not that we ever read it. That was probably the only kind of book of substance in the entire house.
You haven't said where you grew up at.
Southwest London. We had a little maisonette in a place called Mitcham in South London. So my father could get up to Soho, where he was working at Talk of the Town and the Café Royal, these kind of places. Then they moved to Hampton by the river, Hampton-on-Thames, very close to Hampton Court. It was just a great time growing up.
You were the first in your family to go to university. You ended up studying politics and economic history at the University of York. Now, the saying is, if you can hold a fork, you can go to York. What was driving that decision to the University of York, and why that combination of politics and economic history?
I have an identical twin brother called David. He was at the BBC for 30 years. David was mentored by somebody at a school or college, and he got invited to apply for Oxford, and much to everyone's amazement, he got into University College Oxford to do politics and economics and philosophy. Both of us were quite, and still are, driven strongly by faith, matters related issues about how we see the world and our role in the world and our life stories. And that has been a big driver for me. And for me, it was about how we would, this was a 15, 16-year-old, how we would develop a kind of a pro-poor approach to, particularly to development, particularly in the global south. I was thinking about those issues from that age, but often with discussions with people at my local church. So that was what triggered the politics and economic history. And I was so interested in this. How did I get to go to York, Scott? I didn't know anybody who went to university. So I met this guy down the park called Bob. I said, well, where did you go to university? He said, I went to York University. I said, well, what's that like? And he said, oh, it's very nice. And so I said, okay, I'll apply there. So I applied to York, and that's how I got into York. I mean, I wish I could say that we went online and we downloaded a load of prospectuses and we had a long conversation. We spoke to our uncles and relatives, and they said, well, you want to go here and go there. But no, it wasn't anything like that. Well, my dad didn't speak English very well until I was about 6, and I was in remedial English. I couldn't read until quite late. I was not very good at reading, which comes apart from an immigrant kind of household. So it was a bit of amazement to get into university. So my school were not expecting me to pass my exams. And so they had me lined up to work basically to do art. And not that I'm good at art. So they said, look, you're not going to succeed academically, so we don't think you're going to be going to university. So we think you should train and go to art college, and maybe you'll get a job working in painting or something like that, or graphic design or something like that. But my story went in a very different direction, didn't it? And I got to say, if you asked me as a 16, 17-year-old, what I would like to be doing, and ask me now as a 61-year-old, I would say I'm doing exactly what I wanted to be doing when I was 17.
So many people I speak to have this story of some teacher or someone who identified a seed in a person and really nurtured them and helped them. And it doesn't sound like you exactly had that.
But I have a series of interventions in my life which are almost like decisive and purposeful. And one of it was deciding to cross the Sahara at the age of 21 with a couple of friends from university in the back of a truck. This was 1985. Driving down through West Africa, through Mali, Niger, Burkina Faso, and then back through Algeria and Morocco. And I'd just done this degree which included the politics of rural development. And I saw these camps, and my people I was traveling with didn't seem to think anything that was unusual about this. And I realized I was in the middle of a big famine camp of people that had moved in. This was in West Africa. And of course, that was the year of the big famine. And when I got back, this guy that I knew from my local church, he was an agricultural economist. And he said, look, why don't you come and work with me? I just got this gig working with Band-Aid, Live Aid, analyzing the projects and pulling together an assessment of all the different projects by contacting the different universities to do an assessment. And do you remember this with Bob Geldof and all that?
I'm old enough to remember that. Yeah.
We did this assessment work for about 1.5 years or so, maybe 2 years, going into their decision-making process. Then this is a guy called Phil Riddell, who lives just near Geneva, by the way. I think he's on the French side now. He's a well-known agricultural economist. And he said, look, there's a guy I know who's going to pay to cover your fees to go and do your master's at agricultural college, which I did. I went to Y College, which is like a farm. It's like a college farm in the middle of the countryside. It was lovely. And I specialized in tropical agriculture. And I did my thesis on environmental cost accounting techniques. And I was part of a project that Phil was doing in Ethiopia. And so I thought, well, okay, so I'm back to doing agriculture again. Here I am. I'm like the next stage, I thought, right, I'm going back. I'm going to go and work in East Africa. And I've learned all this stuff about agricultural economics and project management. And I went to work for a family that were involved in the first fair trade Coffee Direct. And it was called the African Coffee Company, locally owned, but also with British involvement of the family called the Schluter family. I had a great time working in Tanzania and Kenya, but I fell ill, which was not what I was expecting. And I just met what is now my wife back in England. And so they said, okay, when you're not very well, we're going to put you on a plane to find out what's going on. And we're going to fly back to London, but you'll be all right. After a week or two, you'll be coming back. And I got to London. I discovered I picked up this thing called Bill Hart's here, which is a parasite that gets in through water into your feet. But there's no bilharzia in East Africa, well, at least not where I was. I picked it up the year before when I was crossing the Sahara, because I did this guy. I love life. And this guy I met in the desert, a Tuareg tribesman, he had a beautiful sword. And I said, can I have your sword? And he said, yeah, but I want your shoes. So I traded my shoes. I gave him my shoes for his sword. I thought this was a great deal. I had a pair of flip-flops to replace my shoes. And I had this beautiful sword, which was sort of in the back of the truck. But of course, my flip-flops, which were $1 pair of flip-flops, which were not very good for crossing the Sahara, they fell apart. So I ended up, the last month or so of my journey, not having anything on my feet. And so I picked, in goes thorns and other things, and in goes what became bilharzia. So the family said, well, maybe you're not coming back to East Africa, and maybe you're going to be in London. So I stayed in London, and this is 1988. I thought, well, this wasn't my planet. What am I supposed to be doing now? Begun to be slightly politically active with a sort of middle center left party that had just been established at the time called the Social Democrats. And met this other guy down the pub who's still a good friend and ally, and I had a drink with him just the other night, called Tom Bug. He said, well, I'm writing a book called The Green Money Guide. And he said, we're going to work out how we're going to green finance. And he said, and the other writer is this woman called Tessa Tennant. She'd just set up the first of the ecological funds called the Merlin Ecology Fund, which has now got about $1 billion of assets now. But then it had virtually nothing in it. And so Tessa said, well, come to my office, and we're going to start writing this thing together. And then you can train to become, to work with me as on the fund management desk as an analyst. And we're going to start investing in green companies together. And we're going to build this new thing. And she said, I like the fact you did agricultural economics and you did environmental cost accounting techniques. We can use that because you're going to start evaluating companies and we're going to start making investments together. That's how I ended up in the city.
And that was at Jupiter Asset Management.
Well, it became Jupiter. So Jupiter acquired Merlin, and now the Jupiter Ecology Fund. And then I met the next best or probably most important mentor of my career, which was Tessa Tennant, who went on to found things like the Carbon Disclosure Project, ASRIA, the Asian Sustainable Investment Association, the IAGCC, the Institutional Investor Group in Climate Change. She was remarkable, and she knew the Americans. So she knew Amy Dominy, Peter Kinder from Kinder Leidenberg Dominy, and she knew Joan Bavaria from what was then Franklin Research and Development, it's now Trillium, and introduced me to all these people. And both of us had a passion for not just how do you manage money, but we had a passion for how do we change the world of finance. So she was on this mission, and I realized I was on the same mission. I realized that, of course, doing fair trade, agriculture, and doing sustainable rural development was important, but far more important was changing the terms of trade between the global south and the global north, and thinking of smart ways to move money from the global north into sustainable development in the global south, which is something that I think about all the time. Here we are 14 years in my professional journey. And Tessa was also great fun. I mean, she was a party goer. She was married into an aristocratic family with a big castle in Scotland, and she was surrounded by the smartest minds and the greatest people, and a lot of energy. And those 5 years working in those early days, what is Jupiter's now a listed fund management company, pretty well known, were just great fun. And I used to sneak in my friends working, analyzing oil and gas companies and climate change. And we used to have people come in working in our office and doing investigations into companies. And so we were part advocacy, part fund management, but also policy driven. So we both ended up working on submissions into the 1992 Earth Summit, where this business guy called Stefan Schmidheim had written a book called Changing Course. And then there was another one called Financing Changing Course, which was all about putting the sustainable development goals as they became to be known, putting them around global financial markets. So how do we just transform equity markets and debt markets? And of course, that pivot point for my professional life as a relatively young man, I would have been, how old? 24, 25. Sat in fire, all these things that drive me today, Part will drive me mad, Scott, but they continue to drive me.
You told this story about being in Africa. That was when you were in Tanzania and Kenya, working with fair trade coffee cooperatives. And you just mentioned the Schluter family. Is that like John Schluter's?
Yeah, I work for John because he created a business in Geneva.
In Nyon, just outside of Geneva. I know John very well. And then he started some kind of an NGO for coffee, for fair trade coffee.
Equity for Africa or something like that. And my twin brother worked for Michael Schluter. I also worked briefly for Michael Schluter. I worked for John Schluter. I worked for their coffee trading business.
In Geneva?
Oh, the family used to have offices all over East Africa. So I worked in their Moshi office. They had an office in Nairobi. John Schluter will not remember me because I was like that, and a lot of young people working for them at the time. And they were a really influential family. Still are.
It's Cafe Afrique. I remember it now. He retired from the business and gave it over to the next generation. And he's moved back to the UK now. I've seen him a couple times in London since he's moved back, but I used to see him all the time in Geneva and Nyon. And actually, I know him through our church. We used to see each other socially quite a lot. When you were in Africa, at some point, you came back with a conviction that market rules, not handouts, change lives, which is a profound insight that seems to have affected you. Can you walk me through what you witnessed that fundamentally changed your worldview on that it's not all about NGO work?
When you work in the sort of what you might call the development game, you talk about investing in projects. So what I saw particularly at that time with Band-Aid Live Aid were a whole series of projects by fantastic organizations. But some of those projects were definitely to do with relieving immediate needs like hunger, food. But some of them were actually businesses. What we're talking about were not projects. These were businesses. And the real question of these businesses were, how would you make them sustainable? And you would make them sustainable by having a fair trade, ethical way of running those companies where the local people would own the businesses or a big chunk of the businesses, which was the model with the African Coffee Company with the Schluters. So you had to be clear about what kind of businesses and what's the role of business. And then how do you finance those businesses? And then the much bigger question was in whose interests and benefit are these businesses being run for? Which is a bigger question. Is it for the community? Is it for the shareholders? Is it for the board and the management team? Or is it for the customers? These questions that we all struggled with the last 40 years. So I decided that the only way to change capitalism is to take control of the capital. And so I came back to London with the conviction that we needed to create our own forms of capital through funds that we set up that the public back. And then we would then make the choices about what kind of businesses would be financed. And that we would play a role in that. And we would rethink what is the role of the capital markets. But there's no point doing that from the outside. You have to be a player. You have to do it from the inside. You can't bleat about the problem without playing a role in being the answer to the problem. I was, allowed through these, remarkable kind of meetings of people through my professional life to be able to, in my own way, try and find answers to those questions through what I did professionally. And what I wanted to see was an economically and socially just system. I mean, when I did my economic history, of course, you're studying the whole history and legacy of colonialism, which was an extractive system to grab stuff that ended up back in the hometown, typically London, from all over the developing world. But at the end of colonialism, we needed to rethink the good things and the bad things about this, and then how to restore and reform it in a way that was probably more locally owned, using capital that was locally generated or actually from the outside. And people forget this. On the London Stock Exchange, well into the 80s, there were a whole series of what you would call plantation companies listed on the stock exchange. And many of them doing things, coffee and tea and things and other commodities, which you could have applied an economically and environmentally sustainable way for them to be managed. But where you could bring an alignment to the shareholders, the investors, an alignment with the business, but also with the community and the workers working in these kind of tea operations. But it had to be thought of in a very different way. It had to be thought of more of a structure that allowed others to enjoy the rewards of their own work, and not something that just sent checks back to shareholders in London.
you talked about how you ended up in the city and then starting what would become Jupiter's Ecology Fund. It was 1989, I think.
February 1989.
Yeah, way before ESG was a thing. And when you started this fund, what were you actually investing in? Was there an idea that were you able to convince people that ecology and financial returns could be talked about and achieved in the same conversation?
If you saw the adverts that we had in the papers, they were adverts about breakthrough technologies that solved environmental problems, but were presented as good ideas. So we were finding business people with innovative solutions to particular problems. So our first investments were in energy conservation and insulation and in instrumentation and in more efficient boilers. And I made my own first couple of investments. One was in a recycling business called Waste Recycling PLC that became a £1 billion industry company rather. It was a 10 million market cap, so tiny. And another one was called California Energy, which is a Californian geothermal energy business that we made money from. So there were companies there. It wasn't all the body shop. So Tessa had this view, and her view was invest in the best, avoid the worst, and then try and make the worst into the best. So it was like find leaders, avoid laggards, and then try and make companies better performers. So what you can think of now as stewardship. My thinking evolved much more for those years into what is the investment opportunity behind solutions providers that makes a very sound investment case, and then make sure that these companies behave to the best that they can. So we developed what you would think of as a multi-thematic investment approach. So healthcare meets social housing, meets educational materials, meets environmental. So we built this almost like multi-sectors, multi-thematic strategy. The definition kind of broadened. Some of it I think ended up in a bit of an intellectual dead end, what some people call best in class, where you're picking companies from different sectors. That was the research process. I understood at the time, but that was very much the thing for the 1990s. And by the noughties, I was much more interested in how can we pick really exciting growth companies? Because at the end of the day, you're trying to build the assets for people, your investors, whilst ensuring that the best companies get the capital they need to thrive.
Was this all public equities or was this private markets?
Yeah. Do you know what, Scott? I don't know about your own kind of investment practice, but I like the fact that we could do private investing. So can you believe this? Well, the public market fund, what was called a unit trust, they're now called OICs. You could own a private equity fund, which we did, a couple. You could own other people's investment funds, which we did, primarily investment trusts. And you can own pre-IPO situations, which we did. And you could own like private placements, like early stage companies. And we owned a pile of those, all in what was a unit trust. And then we launched, this is 1992-3, we launched an investment trust which is still around, called the Jupiter International Green Investment Trust. And I was one of the, investment analysts on that fund. So we could do things. Now today, if you tell people that you've got a private equity fund in your OIC, you probably go to jail. You couldn't do it. But then nobody seemed to bat an eyelid. And we started to experiment with the cash holdings. So today, when you've got the cash elements of your fund, you're expected to deposit at, I don't know, HSBC or Barclays or whatever. But we were depositing the cash at Triodos, the social bank in the Netherlands. And we're going, well, why not? This fund's always going to be 5% in cash. So long as we can access the cash, why not deposit some of the cash at a social bank? We were constantly trying to think through ways of breaking the mold. The other thing we did is, and this is Tessa's kind of view, is you use the fund management fee to build a research team. And so instead of using the fund management fee to pay everyone massive salaries, because we weren't earning a lot of money, we would just triple in number, and we would have more and more analysts covering more issues, and we would deploy stewardship techniques. So talking to companies about how they manage themselves, as well as investing and publishing analytics. I kept the press clippings, and we were in the papers all the time in the 1990s and late 90s with the ideas and so on.
And then you went to AMP Capital.
So what happened was there was a fallout at Jupiter. So it turned out that somebody in the management had a brother who works in government, and the government was privatizing the water industry. And we wrote a very critical report on what would happen if the water industry would be privatized in the UK. And we went to publish, and then the brother said, "Oh, this is criticizing the government. You're criticizing the government by publishing a critique of the water companies." Tessa quite rightly took this as a point of principle and said, no, this is a point of principle, the independence of being able to write without constraint. And so we upped sticks and we went to work for a little life company called National Provident Institution, a Quaker-based life company. And that allowed us to go from a few million under management to about 2 billion within about 5 years, because they had the distribution that we didn't have at the time at Jupiter. And the funds were performing well, and I was out on the road all the time. And then this thing got acquired by AMP Capital. And in the year 1999, 2000, they said, "Oh, come to Australia and launch the funds in Australia." And I went to Australia to launch the AMP Sustainable Future Funds for AMP Capital. And I moved to Australia, and one of my sons was born in Australia.
And then you went on to Henderson Global Investors.
So AMP actually owned Henderson. So when I went to Australia, my colleagues went to Henderson Global Investors. It's now called Janus Henderson. AMP owned Henderson for a while. They then demerged it and it became a separate company again. So I was part of the fund management team at Henderson. Yeah.
How did that compare to what your original concept at Jupiter?
A couple of things happened. One was that you're now part of a much, much bigger organization that's doing multiple things. The other is that the public profile that we had meant that we were saying things that probably institutionally and doing things institutionally that they were uncomfortable with. On 2 billion, the fund management fee was pretty good. They didn't like the fact that was going into research. So there's a big question mark about, why have you got so many researchers and why are you doing all this policy stuff? Can't we be paying this to shareholders? And more importantly, for some of the management, paying it to ourselves? You know, some of these people were on insane multi-million pound salaries. They saw this as a kind of a jewel, but one that could be bled dry at the same time. That was a difficult time, and that marked Tessa leaving because she felt that if it wasn't going to be independent, if it wasn't going to be resourced, she didn't want to stay. And then she went off to live in Hong Kong and launch her Asia stuff. And then you realize that if you don't control your own company, you can spend 60, 70% of the time challenging your management. And who wants to be doing that? And the company said, "Oh, we'll let you consider buying yourselves out." So myself and a couple of others, we put together a consortium to buy ourselves out and reestablish an independent platform. And they said yes, and they said yes. And we had lots of meetings. And then one day they came back and said no. And by the way, you're all fired.
That's where your insight to how the market,
yes,
is what makes the difference.
Yeah, well, fair dues. But for me, this was 15 years of my life, 20 years of my life of not being paid particularly well, because I thought we were building a franchise at something that was going to, really change the way capital markets are thinking. But there were other plans at foot. So that didn't happen. That was in the year 2007, 2008. So I thought, oh, wow, I wasn't expecting that one.
What year that happened?
2007, 2008.
So before we get to that, you did something in 2005, which sounds like it happened in parallel, and you founded the Social Stock Exchange.
Let's talk about that. So around the early noughties, I realized that a lot of foundations and families were interested in what you would call mission-related investing. So they had a purpose as a family or as a foundation, and they wanted to invest their assets in a way that would be aligned with their values. So mission-aligned investing. And that often meant picking companies that were directly doing the things that the family or the foundation were interested in, healthcare or renewable energy, whatever it might be. And at the same time, this was the rise of the social enterprises. So how do social enterprises raise capital? And the first of the bonds that were being issued, social purpose bonds. So if you wanted to raise money, you would join the queue, list on AIM, become part of the London Stock Exchange. And then people doing responsible investment would then screen you. And if you were lucky, you might be found. But most of what you would call responsible investment is just screening out some companies from the MSCI 1500 stocks. So how do you finance all these amazing little social enterprises and social purpose businesses? Where's the capital market for that? That led to the idea of, well, let's create a social stock exchange. It's the exchange that is important, let's put a couple of hundred companies onto the market and let's create funds like we did with the Jupiter Ecology Fund, whose main goal was to invest in these companies. So one of the changes, I didn't answer your question, Scott, about the move from the small cap investing that we were doing at Jupiter and MPI, is it moved to large cap investing. And they said, well, let's get rid of all these smaller companies. And the fund was 50% small caps, 30% mid caps, 20% large caps. And by this time, all the private equity and pre-IPO had got. And then suddenly it was all large cap investing, which didn't interest me because I wanted to I'd invested in waste recycling, 10 million market cap. It got bought out of the market at $1 billion market cap. The whole point of investing is to grow companies and find successful companies, not trade the top 100 companies in the world. So social stock exchange was to create a capital market for social purpose businesses. And with a grant from the Rockefeller Foundation, I brought in this guy called Pradeep, but I was at that time the main shareholder, to give it a go to create that company. And this was at the rise when social impact investing had begun to appear. The Jim had gone to the first meetings of the Global Impact Investing Network with some amazing people like Anthony Levine and John Goldstein and many others from America. Yeah, so that takes me to 2007, 2008. And I just lost my job in Henderson. I was thinking, well, what am I going to do? And I did a little bit of corporate finance for 8 months or so. But then I went to something called the SCO World Forum, where I've been a speaker over many years. And on the train back, I met this American called Harry Halloran on the train with his friend Tony Carr. And Harry had set up this thing called Halloran Philanthropies. And he said, I'm going to finance the B Corporation movement. And he said, I want to fund the first of the impact funds. And I'm going to back SOCAP, which is this big conference on social impact investing in San Francisco. And he said, Mark, you're going to come and help me do this, and I'm going to back the social stock exchange, which he did. And he said, I also want to give away millions of dollars of my own money, but I also want to invest millions of dollars of my own money. So become part of the team. And I joined a great team of people, which I'm still in touch with a couple of them now. Audrey Sellian, who probably lives close to you in Switzerland. She works for Rianta Capital. She was part of the Halloran team. And that started a new chapter in my life of going off to America and meeting people and building social stock exchange.
What actually was the social stock exchange?
So what we did is there were two parts to it. We would take companies doing medical devices or healthcare or educational materials or nursing, a recruitment agency or a arts cooperative where a group of artists through a listed company would transfer their art into the company in return for shares backed by a foundation but with a free float, was on a stock exchange listed company. It had a market cap of $1 million, so tiny. And then companies, really interesting companies. And so they agreed to come together to create this platform. But the idea was, the second part of it was to create a live IPO place for more companies to list. Now, the big thing that I wanted to do was in the UK, if you invest in shares through a pension plan, you can get tax relief. And if you open in the UK what's called an individual savings account, an ISA, you can get £20,000 a year of tax-free investing for life, free of all taxes on dividends and income and capital gains. And I thought, well, let's create an alternative to private equity and VC-backed and over-the-counter private shares. Let's create a marketplace where people can put this in their pension plan or their ISA, and companies can create a rules-based system where you put social purpose at the heart of the exchange. The idea at the time was that it would be a marketplace for B corporations and what are called today community interest companies, or in the US, they're called benefit corporations. So instead of saying, let's take the stock exchange and screen companies in or screen companies out, let's create our own stock exchange where all the companies meet your criteria, because the admissions process only selects for B corporations and social purpose businesses. And if it could grow and we could create liquidity by launching funds, if it could grow, then you would create an international financial market driven by values at the heart of the process and at the heart of the whole of the function of that capital market and the way people trade and the discussions you would have about how it would be run and so on. So that was the vision.
What was the structure of this whole thing?
So we cut a deal with the London Stock Exchange, and they were going to give us a segment to us, part of the market. And we were going to create a trading place, or we were supposed to be a trading place with listings and IPOs. And then you would hit socialstockexchange.com and you would see the listed companies there with the price. And then you'd be able to find a broker who made a market in those shares. And if you wanted to buy them, you'll be able to buy them. And then fund managers and dealers will be able to have a screen where all the companies on the social stock exchange, where they'll be able to see prices and bid offer spreads and so on. That was the vision I had for social stock exchange. Within 6 months of me launching it, I was removed from the board. And they said, we don't need the founder anymore. It was launched by David Cameron a few months later. Life plays these funny tricks. I didn't even get the invitation to the launch to my own business.
Does this actually exist then?
Okay, so what then happened is that they raised millions, and the money, they pivoted. Instead of taking companies around the world that are already listed doing these things where you can get liquidity and they already have an institutional shareholder base and you can build off that and you can bring in new investors onto the share register. Instead of doing that, they turned it not just into a pre-IPO market making place, but a private placement place, but even for startups, not for listed companies. And people confused what is an exchange or a market with an index. They thought it was some kind of index, which of course it wasn't. It was a marketplace. And then 4 years in, the board asked me back and said, can you please explain what your original vision was? And I said, this was what the original vision is. This is what I thought we would do. And they said, yeah, we thought this is what you said. Thanks very much. And goodbye. And then I didn't hear from them again until it entered insolvency a few years later. They were not able to create what was the original plan.
Another folder in the road to hell is paved with good intentions file cabinet.
You often hear this, like people go, don't trust the founder syndrome. Get rid of the founder because the founder will be the one that leads you to disaster. Fair enough. But to totally change the business plan because they didn't understand the business, because it was my business and they didn't understand it.
They didn't have the vision, didn't have the passion.
It is what it was. But do you still think that there's a place for this today amidst the noise of the Metas and the Googles and the Microsofts? I still think there is a place for it today. But whether I would do this again in my lifetime, I don't think so.
It looks a little different from when you're over the 60 than it does when you're younger.
Right. Somebody said to me, let's give it another go. Can you just remind me of how we should do it? And I would jump in because I somehow think I still ended up owning the domain name. I still own socialstockexchange.com because for some reason it was never transferred to the company.
Those ideas die hard. So we got to move on because we got so much I want to talk to you about. You started Carbon Tracker around 2009 or something like that.
So early on in the early noughties, I began to see a lot of coal, oil and gas companies raise money on the London market. And when you read the prospectus, and I would read these documents, particularly there's one called Xstrata that's become Glencore. The numbers of times reference to climate change or the climate agreements was mentioned in a 300-page prospectus was down to like 7 or 8 lines. I thought, well, this is wrong from a regulatory point of view and from a financial point of view. What is the significance of these listed companies in terms of their contribution to global warming? Is it 5% of the problem, 50, 150% of the problem? We just didn't know. And so I had this ticking on the back of my mind. And the other founder of Carbon Tracker, Nick Robbins, we had the same kind of question together. And we started writing about this in 2005, 2006 with Sahara and lecturing on it. I was lecturing on it and looking at this. And we then came out with this side of the carbon bubble. Of course, I was working with Harry at this time. So I hired in some people to answer the question of how big is the Chevron, Exxon and Shell contribution to global emissions? And are there reserves? What percentage of their reserves could be safely developed inside what we now know to be a well below 2 degrees of warming? John Lennon has this amazing quote that says, life is what happens when you're planning to do other things. I thought I was developing the social stock exchange, backing social purpose businesses and, transforming capital markets. But actually what happened was this little report, which we wrote, we had a very boring title on. I found this fantastic researcher called James Leeton, who was the lead writer of it. I had a very boring title, and about 24 hours before publication, Nick and I decided to change the title. It became Unburnable Carbon, Are the Financial Markets Carrying a Carbon Bubble? So we put in the phrase Unburnable Carbon and we put in the carbon bubble. And we published 100 copies. I didn't even go to the launch because I forgot my wife had bought me tickets for this festival out in the countryside, which I went to with my kids. So I didn't go to the launch. And I'll give this other saying, good ideas are a curse until you can get rid of them. So social stock exchange had been a curse. The carbon bubble idea had been a curse. And you're just trying to get rid of these ideas. And I thought finally at last I managed to get rid of this thing. We've published these 100 copies. And what I hadn't realized is that somebody at the Rockefeller Brothers Fund had funded it, had given a copy to this American woman called Naomi Klein, who's a writer in America. And Naomi had given it to another American called Bill McKibben. And Bill McKibben then wrote this article, Global Warming's Terrifying New Math, in Rolling Stone magazine. And he misread the conclusions of the report were we need to rewrite the rules of the capital markets, prospectus rules and listing rules and blah, 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 and fiduciary duty. I don't think he misread it. He said, look, no, Mark, when you come up with something like this, you have to have a very simple ask. And my ask was we would divest from fossil fuels. And he said, well, come out and to the US, we're launching the Do the Math tour. So Do the Math was a title from the Unburnable Carbon report. And it had hundreds of thousands of downloads to Rolling Stone magazine. And I went to New York to the news school, the big hall there, and it was jammed with people. I thought, well, who are all these people? And it mobilized all these student activists who then went on to persuade all the big universities in America to divest fossil fuels. And then in London, Nick Stern had picked up the report and we went to see him and he said, a great report, guys. I just wish I'd thought of it. I thought, well, that's an amazing compliment. And Martin Wolf, who's a leader writer for the Financial Times, wrote a big column in the Financial Times. And this thing then took off. And then JP Morgan got in touch in Goldman Sachs and they said, will you come and present at our conferences? And can you present to the mining and oil and gas team? And we thought, well, maybe there's something here. And then these foundations that appeared, the Grantham Foundation and Bloomberg Philanthropies and Wallace Global Fund and the Joseph Rowntree Charitable Press, they said, look, build a team and let's transform capital markets and let's take on the fossil fuel industry and let's get the financial system out of fossil fuels. And that led to the carbon tracker, which is still thriving today.
Why don't you explain your thesis in the Unburnable Carbon report?
So what is the thesis? A very, very simple one, which is that the science tells us that we have a carbon budget, how much CO2 we can emit to the atmosphere before we go through different levels of warming, 1.5, 1.7, 2 degrees, 3 degrees of warming. And that the carbon budget was running down fast. In fact, the carbon budget is out for 1.5 degrees. We're through that. And for 2 degrees, it's about maybe 700 gigatons of carbon dioxide. The problem we identified was that when you look at the CO2 in the reserves of Chevron, Exxon, and BP, it's 1,000 gigatons. So they own more reserves than we can possibly burn to stay well below 2 degrees. Now, why is that the case? Is because governments own another 3,000. The Saudis, the Americans, the Canadians, and so on. So that's 4,000 gigatons of carbon dioxide chasing, if we keep to 1.7 degrees, chasing 400 gigatons, 500 gigatons. So it's a game of musical chairs. We've only got one chair left and there's 7 people running around us saying that chair is mine. The Saudis are claiming it. The Americans are claiming it. The Brazilians are claiming it. The Norwegians are. And of course they can't unless we burst through. So that's what the carbon bubble is. It's a carbon bubble. Far more fossil fuels are owned in public markets than we can possibly use. And so that became the financial risk, that the system would be destabilized by the trillions still invested in coal, oil and gas, and ultimately by climate catastrophe would destabilize the financial system. So those were the two big ideas behind the carbon bubble and carbon tracker.
Well, there's another one. It's stranded assets.
Our second report on stranded assets and wasted capital said, if we can't burn what has already been financed, why are we building even more? These will never be used. They'll become stranded. But it's also financially stranded. So you put up the billions and now the trillions in this infrastructure. It will never generate the return on capital that you thought it would do when you first invested. So you can have physical stranding, you won't use the assets, or you can have financial stranding. They'll never generate the return. And you could have it both at the same time.
This report, Unburnable Carbon, came out in 2011. First of all, you have something called Carbon Tracker, and then there's something Carbon Tracker Initiative. What's the structure here? And all that started before that.
It was always Carbon Tracker Initiative. And their website's just carbontracker.org.
Okay, so that's all the same company.
It's the same thing. But I created this new thing a few years ago called Planet Tracker that's looking at nature and ecosystems, at forests and water and so on. So, but Carbon Tracker, think of it as really as the mothership.
You started that like officially in 2009 with how many people? What was the idea at that time?
There weren't any people there. So it took me 3 years to raise £5,000 because of this thing called efficient markets. People say, if what you're saying is true, I had one foundation say this. He said, if what you're saying is true, the markets would already know this by now. And so because the markets don't know this, there can't be anything to what you're saying because markets reflect all known risks. And I knew that was rubbish. And then people said, we don't know what you're talking about. What are you talking about? Financial markets and climate change? We don't see the link. Go and spend all your time trying to persuade governments to create a carbon price or have a tougher climate agreement. Now we need both of those, but I wanted to do something immediately now, get people out of funding fossil fuels. It took a while, and it was a young philanthropist called Jamie Arbib who gave us the first 5,000 to do the initial work. And then the Rockefellers, the heirs to the Rockefeller estate, got in touch. And with that allowed me to hire James. And then when the first of the rest of the money came in, we hired 2 more people, Luke and Margarita. And then when Social Stock Exchange said, we don't need you anymore, I then pivoted and realized actually, this is what I was supposed to be doing. And I essentially became part of, building our carbon tracker because I was doing loads of their events anyway and speaking and doing, interviews and presenting to these financial institutions who everybody just wanted us to come in and explain the basic maths of what it was.
And today, do you have a number of employees?
Carbon Tracker and Planet Tracker together, we have 40 people here and still entirely funded by philanthropy. And we have a philanthropic purpose of educating and informing financial decision makers. And we work with people like Climate Action 100, providing data through groups like Climate Arc on what the oil and gas companies are doing. We have a very clear argument about let's stop the expansion of the fossil fuel industry. The problem is still there. And we have an accounting and audit team. Let's change the financial regulations for coal, oil and gas, which is still very active. And we're slowly getting to where I wanted us to be. But I got a few gray hairs.
So to put bookends around so people can understand what Carbon Tracker's initiative is about. Overall, do you want the end goal to be from your work to stop investment in fossil fuel projects entirely, or do you want divestment from companies? Or what's the theory of change for you, even though you're not investing?
The goal is to align global financial markets with the science of climate change, the goals of the Paris Agreement. So you don't produce more fossil fuels than we need to stay to within a well below 2 degrees outcome, ideally 1.5 degrees. Now, the International Energy Agency has said that to achieve 1.5, the world does not need any new conventional oil and gas or coal anywhere. We don't need any new stuff. So we're constantly challenging why you're building more. Of course, we want people to not invest in fossil fuels or divest from fossil fuels, but we need to change the admissions rules particularly of bond issuers to the fossil fuel industry, issuing bonds and issuing equity. So we need the financial regulation to change. But what are our metrics of success? So Goldman Sachs and Forbes wrote about 18 months ago that since the stranded assets argument hit Wall Street and the City of London, global oil and gas reserves have dropped from 50 years to below 23 years. So we've halved the reserves life of the global oil and gas sector. Now, when the foundations originally funded us, they said, Mark, what are your metrics of success? I said, stopping investment in new oil and gas. So I wrote back to them saying, Goldman's has just written that we've halved the life of oil and gas reserves from 50 years to 23 years. Some of them replied. I think one wrote back and said, that's very nice, Mark. But sometimes foundations move on. I think there's a big success. I wish they'd come back and said, okay, great. Now what's the next thing we need to do? But of course, they never do that. They never go, well done on achieving your mission. Now tell us what the next step is. They're forever looking off, wanting to do something different. Not the Rockefellers, by the way. And the Sainsbury family kids, they've stuck with it. They really understand what this is about. Others have moved on, which is a bit sad for me. It's still to align financial markets, financial regulation, pension funds with well below 2 degrees to ensure that the supply is in line with the remaining scientific carbon budget. We don't produce more fossil fuels than we need to stay to well below 2 degrees. That's ultimately what Carbon Tracker is really about.
Then this report you published in 2011, Unburnable Carbon, which ended up being the basis for this Rolling Stone article, which put it out in the public zeitgeist. Your concept is that there's only so much carbon can be burned in the future as far as we see. But all these oil and gas companies are capitalized with amounts far beyond what could ever be burned. And so you're saying we have this huge imbalance. Is that the carbon bubble that you're referring to?
So what we've never said is the carbon bubble is a financial bubble. And I'm going to tell you the reason why. If you take the market cap of the world's coal, oil and gas companies today, it's about $7 to $8 trillion of market cap. But if you took the value of their reserves and took today's price of a barrel of oil, a ton of coal, and multiplied it by how many tons they own and how many barrels they own, it's around $120 trillion. So that's the future revenues. That's the value today in today's prices of the reserves controlled by the world's coal, oil and gas companies. Now, obviously, there's a big delta between 120 trillion and 8 trillion. And the reason for that is the market already discounts the probability that these reserves will ever be developed. So you can't draw a direct line between the size of the reserves and the valuation of the company. But what we do know is that when the companies downgrade their proven reserves, their share prices tumble. And that happened with Shell a few years ago when they had to sort of restate their reserves. So there is a link between the reserves and the valuation. So what we've seen happen is that the oil companies, particularly in Europe, are on low single price earnings multiples. So the market is not giving a premium to the future value of those reserves. They're not believing these reserves will ever be developed. My view is that the companies should be debooking the reserves that break or outside of the carbon budget. And the market should be, regulators should be picking this up strongly. And I'll say this, the reason for this is, I don't know if you saw this, in the last year, Saudi Aramco issued about 6 billion in bonds, some of which were dated 2060. So 2060 is way beyond when we should be using fossil fuels. My answer to the question, should we stop investing in fossil fuels? My answer is we should stop burning fossil fuels. I'm not against oil and gas per se. I'm just against setting it on fire. Now, if you look at this thing that nature's given us, we could be using it for complex plastics, pharmaceuticals, other industrial elements. But instead what we do is we set fire to it, which is just crazy. And it could be that these companies are worth far more, much smaller. And by having higher margin products where you take this critical resource and convert it into something really useful for society. And I don't mean plastics, but not mass consumer plastics, specialist plastics like used in the pharmaceutical industry, the car industry and aeronautics and so on. What I'm absolutely against is this idea that you take this resource, which has taken hundreds of thousands of years to be created, and then you just put a match to it and it's gone. People will look at the last 50 years and go, well, we've just destroyed this extraordinarily valuable resource by burning it and also potentially destroying the planet along the same way. There are some parts of the world you would never want to develop oil and gas, like the Arctic and the rainforests and areas where you've got indigenous peoples and so on.
So I want to hear the origin story. Tell me about the initial back of the envelope calculation that brought these ideas to light.
Nick and I, and a few others, Professor Mark Campanale, who became the mayor of London just relatively recently, we were trying to figure out whether the Chevron and Exxon were a small part of the problem or all of the problem. And we also wanted to know the links between the levels of heating that we've been seeing in the planet, which have got the highest levels of carbon dioxide for, hundreds of thousands of years, and warming we've not seen in human history before. So we know we've got a major problem. Is how much of that is due to Chevron and Exxon and Shell. And what we concluded with the publishing of Unburnable Carbon is that they are 100% of the problem because all of their reserves take up the remaining carbon budget. In some countries like the United Kingdom, we're much proportionally more responsible for this than other financial markets. So that was the back of the envelope calculation. Of the first, that £5,000, it was to go to a young American called Connor Riffle, and a friend of his. He'd joined from the Clinton Global Initiative. And it was Connor that did the back of the envelope calculation, this short paper. And he said, Mark, yeah, you've got something here. We should really do something about it. And by the way, I've got myself a proper job. I'm leaving now. I think of him as the fifth Beatle, the guy that if he'd stayed, he would have made his name. But it allowed me to meet a few weeks later. I heard this young guy at a Chatham House roundtable speaking, and I didn't know who the next head of research was going to be. And I heard him speaking. I thought, well, I wonder if he, these random things, I wonder if he's the next head of research. I didn't know his name. I had a friend who worked at Chatham House, and she emailed me, said, oh yeah, that's James. This is his email. And I emailed James, and I explained to him what this thesis, and he said, oh yeah, you may have something in there. And it was him who found the scientist Meinhauser, who did the calculation of the carbon budget, which is central to the whole thesis of the remaining carbon budget. The fossil fuels reserves is an indicator of what emissions will be, because what gets financed and developed will ultimately get burned. It's a forward-looking indicator of what the warming levels will be. And you can link the reserves owned by Shell and Exxon and the others to future warming. You can make that direct link. And in fact, the agreements just coming out in the courts now, the International Court, I think, of Human Rights, just come out and saying, we can now make these links between the fossil fuel companies and the levels of warming. So yeah, interesting.
So you publish this report, you view it or have described it as somewhat of a cathartic act just to exercise these devils out of you. And you didn't even go to the launch because you were at a music festival. And 6 months after you published this report, Norway's giant oil fund began divesting.
There's a bit of history there. So they got in touch and they commissioned their own report from Rystad of our analysis. And Rystad came back with the same conclusion. And then there was political voices in the Norwegian government, Sovereign Wealth Fund, and they started to do their own work on and leading to a divestment case. So that I remember I got all the history of those exchanges with them. I wasn't expecting that either.
And then Bill McKibben launched the global divestment movement. How do you view that partnership between your financial analysis and his grassroots organizing?
Well, we're not campaigners in that sense. We try and produce objective research that's used to either engage with oil and gas companies if you don't think they're Paris aligned, and we don't think they are, and the investors want the analytics, or like PGGM and other big pension funds that want to get out of fossil fuels. So we provide that case, and other local authority pension funds that want to divest from fossil fuels. We present the logic. The logic is now much more driven by the fact that renewables are now the cheapest form of energy in the world. The fossil fuel companies are coming to an end. The question really is a matter of timing. And look at all the sales rates of electric vehicles, which are over 50% in China now. And I was reading yesterday, even in Ethiopia, electric car sales are 60-70% of new car sales. This is a phenomenon taking place all over the world. So this is the death knell of the fossil industry. It's just a matter of timing now. And the investors today want to know, when do we see oil demand falling? What are the oil companies doing? What's happening with coal? I had a great discussion yesterday with colleagues about our work on coal decommissioning in Southeast Asia. And the whole of the economics of this is what the investors want to know. So I was pleased to see this happening. Pleased to play my role as speaker at numbers of these events. And it's curious how these things have a way of meshing together. I don't think without Bill McKibben, to be fair, Carbon Tracker would have taken off in the way that it did.
Let's talk about your current work now at Carbon Tracker. You produce company profiles for over 75 companies across oil and gas and power and utilities and automotive. Who uses these reports, and walk us through what one of these company assessments typically looks like?
It's primarily investors, pension funds and fund managers. I got a colleague to do an assessment. We've had 38,000 downloads in the last 60 days on these company profiles and these reports on Paris alignment and so on, and our audit work. And I was looking at the attendees. We did a webinar day before yesterday on auditing profession. And we had 360 investors and fund managers and companies, oil and gas companies, turning up, coming along to our events. Sometimes we get 500 investors coming to our webinars. So there's some pretty strong traction. I'm really pleased about it. And it obviously is a non-profit. We're not selling services. We're trying to be independent, which is why we rely on philanthropy. Scott, should any philanthropist be listening? It's about trying to change the way investors think about climate change and climate risk by giving them objectively the numbers. And in a way that if you're a fund manager, you pick it up and you can immediately recognize the language, the framing. So we're not We're not an advocacy organization. We're not a divestment campaigning organization. We're a risk management and opportunity organization, but one with a roadmap for what these companies should be doing, which is stopping investing in new production. That's essentially our main ask.
In your research, you use what you call a traffic light system for your assessments. Can you explain how that works?
Well, yeah. So of course, investors want to see what good looks like, and they want to see our views on these companies. So we traffic light it based on key indicators of what they're doing, whether executives are being incentivized to go out and produce more. So we think it's bad to be given an incentive, pay incentive to do that. Whether their investment plans are aligned with different international energy agency scenarios, particularly the ones we want to be is well below 2 degrees. We give a red, orange, or green. And there's other indicators which anybody listening, if you want to go and look at Paris maligned or absolute black, they'll show you what those traffic lights are.
And what does good look like? I mean, beyond green, what does good look like in real life? And what does bad look like in your analysis?
Very simply, good means stop investing in high cost, high carbon projects, start to unwind your investment plans and contract and put yourself essentially into a proper managed decline. So the cash you use to do exploration, pay it out in dividends to your shareholders. So begin to contract and cash out. That's what good looks like. Bad is investing in production which you may not see for 15 years that will be unneeded when you could have used that cash to fund share buybacks and distributions. So that's what bad looks like.
And oil and gas companies' bread and butter is, of course, oil and gas. Moving away from these doesn't exactly fit with their business model. So how can these companies possibly screen well under a 1.5 degree scenario while still having a viable business?
Well, they don't have to do anything except contract. They don't have to become renewable energy companies. Maybe they become specialist lubrication or oils businesses for the wind industry, but there's not a huge market for that. I don't think that they need to pivot and find new businesses. I think they just need to accept that the days of fossil fuels are over now. And now it's time to enter into a decline. So the real question is, can you decline gracefully? And if so, what does that look like? And for us, it's contracting your balance sheet and cashing out. Now, if a few merge as they contract to reach economies of scale, go ahead. But the days of exploration and growth are, in my view, are over.
In 2018, Pope Francis brought together the heads of the world's largest oil and gas companies, along with heads of major financial institutions, to discuss climate change. You were there, and Carbon Tracker provided the background papers for this event. Can you tell me about that experience?
There was a university professor from the University of Notre Dame in America called Leo Burke, and then a woman called Caroline in Ireland who came to see me, would have been, 2016, 17, saying, look, we've got this idea that we're going to bring the oil and gas companies together at the Vatican, and we're interested in your thoughts on that, and what role could Carbon Tracker play? And I said, well, we could play by providing the research and the evidence. But I then said, well, what you probably really want to think of doing is bring the biggest of their shareholders into the room. And they said, oh, well, that's an interesting idea. We hadn't thought of that. Let's do that, because I said the Pope will have a clear voice and they may listen, but they're really going to listen to their shareholders. And what companies need to hear from their shareholders is what their owners think they should be doing. And they said, yeah, great idea. Who could you bring in? And so I said, I know a few people. I rang up a few people and they said, well, okay, I think we can bring. And then they brought the Japanese Sovereign Wealth Fund, the Norwegian Government Sovereign Wealth Fund, and then they brought State Street and BlackRock. But these are the chief executives, not the sustainability officers. So this was an event of the CEOs of Chevron, Exxon, BP, and Mark Worth, Darren Woods, those kinds of people. I mean, this is all, you can see this in the public record. So it's not like, it's not that they wanted their names to be publicized, but you can see it's in the public record. So we had this 2-day event where Pope Francis listened to their cases and their voice, and then the companies spoke, and then the investors spoke, and then we got called up to the palace. Pope Francis didn't use, but he did it for receptions, and he sat high up on his throne with his cardinals and so on, and we sat at the front And he gave his speech about climate change and the Paris Agreement and fossil fuels.
I've seen a photo of you sitting in the front row. Oh, you look smart with the red tie. What was the atmosphere like in the room?
I would say I was slightly curious because I then followed, you then went and greeted the Pope, and you got a bottle of holy water and a crucifix. Was how many of those chief executives kneeled or crossed themselves when they saw the Pope? I thought, this isn't just about what am I doing with my business. There's a little bit of my mortal soul question mark going on here. Not all of them. And so the Pope said something which actually created a bit of a stir. And I kind of had a good guess from various reasons he was going to say. He said, as the Paris Agreement says, most fossil fuels should be kept in the ground. Now, we get back to this ruin, this palace, which is where Galileo got condemned. We're in the same room that Galileo gets condemned. It's a really interesting piece of history. Some of the chief executives, the oil companies, go ballistic, and they said, the Paris Agreement doesn't say this, because of course the Paris Agreement doesn't mention fossil fuels anywhere in it. And the Pope has to retract. And there's this big argument going on. The cardinals, no, it's not possible. And then there was a little bit of argy-bargy going on. And the chief executive of one of the fund managers there, who happened to be the chair of Carbon Tracker, a guy called Saka Nasbi, he's the only Muslim in the room that I'm aware of. And he's got an amazing history. His family hold the keys to the Holy Sepulchre in Jerusalem and have done since Salah ad-Din's days, 900 years ago. So really interesting piece of history. He settles the room and says, of course, in Catholic tradition, it's not possible for the Pope to retract because he's infallible. And so the Pope cannot retract his statement, which of course he didn't. But I think that what he was doing was making the Paris Agreement say what the intention of the Paris Agreement is and what it should have said. But the lobbying of the fossil fuel companies meant that it didn't say it, which is that its intent, all intents and purposes, most fossil fuels should remain in the ground. And Pope Francis, bless him, a more astonishing leader, brought them back to the core question of actually, is fossil fuels that cause the problem of climate change, the use of burning of them, and you as producers pushing for it and developing it are part of this, part of this problem.
Your work has had an enormous influence on regulatory frameworks. Mark Carney, when he was governor of the Bank of England, incorporated your stranded assets concept into his Tragedy of the Horizon speech. How important was that endorsement from such a senior central banker? And what is the role of government and regulation in the transition to a low carbon world?
Mark Carney had apparently read Unburnable Carbon. One of his advisors told me this and written the brief. And he then asked me to present the Financial Stability Board in 2015, the carbon bubble stranded assets thesis. So all these central bankers in a room hosted by the Bank of England, and I got to present this. And he gave his Tragedy of the Horizon speech and picked it up and then led to the launch of the TCFD, the Task Force on Climate-Related Financial Disclosures. It was very important. But there was one thing that I thought that they would do that they haven't done, and that is when a company IPOs or raises money in the bond market, that there should be a risk stress test on whether their reserves will be developed, and that the regulator in the UK as the Financial Conduct Authority would change the prospectus regulations to ensure a climate stress test would happen before new reserves are financed. I thought that they would do that, but instead they did something a lot more complicated around generalized risk disclosure. So I think they missed a trick, but without any doubt, Mark Carney's involvement and Michael Bloomberg's involvement was a hugely important step in supporting better climate risk management through the financial system.
And you're currently working on something called net zero reserves test. And this would operate kind of like a traffic light system for new fossil fuel listings on the London Stock Exchange.
Yes. So we've been talking to the Financial Conduct Authority about correcting the prospectus rules to incorporate a climate risk test. And they've just written and they said they're going to be gathering more evidence. They're going to be looking at risk disclosures and prospectuses, and they think that there's a case, but they want to know more information. So we're in the middle of that process. So we're kind of getting there. I call it, if you can get the reserves out of the ground, as a geological test, we need what I call an atmospheric viability space test. Is there space in the atmosphere for these reserves if they were to be burned?
But why is this needed, and what would it mean for companies that fail the test?
All companies would have to say in their prospectus is that based on the Paris Agreement, most of our reserves are not needed. And then caveat emptor applies. So the shareholders think, okay, fair enough, but I don't care. They would still buy the shares. But for investors committed to net zero, if they read that statement, they would go, we're probably not going to invest in this. And so the market would function better with that disclosure, in my view. And the market will be able to sort of test which companies are more likely to succeed than fail as well, because you would have to do a reserves test against a price test as well. So I thought it was a great idea, Scott. I wish they'd proved it on first outing, but we've got more work to do.
Your analysis has been out there for quite a few years now. The risks are clear, but fossil fuel financing continues to fund massive expansion in fossil fuel production. So how do you explain the cognitive dissonance where markets continue to ignore known risks? Is that just human nature, or are there structural issues in how the financial system operates, like with quarterly earnings, and that make it hard to respond to long-term risks?
So financial markets don't accept the idea of ecological boundaries or ecological limits. Basically, they think all fossil fuels are there to be found, can be developed. There's no constraint. What we're trying to do for the first time is introduce carbon budget into financial regulation as a risk test. But companies, I think the change in behavior of companies, so they are still investing in new production, but the amount that is going into that has been cut dramatically, which is why reserves life have dropped from 50 years to 23 years. And if you look at the amount of capital going into new exploration as a percentage of all distributions, it's dropped each year in the last 5 years. So they're doing more share buybacks and more dividends. So the argument is winning, and the derating. These companies are not rated in Europe in the same way they are in the US. I think we're winning there as well. So it's not going fast enough. But the carbon bubble tells you that we have got far more fossil fuels out there to be developed. And this led to a discussion that I had with Zipporah Berman, who then went on to found something called the Fossil Fuel Non-Proliferation Treaty. And I was the first member of his steering group that says, along with the Paris Climate Agreement, which is an emissions reduction treaty, it's not a fossil fuel treaty, we need a complementary fossil fuel treaty that governments give up all permitting and licensing rights and contract the licensing to within the remaining carbon budget.
But this self-liquidating behavior, that's something that you celebrate, or does it create other risks in the energy transition?
No, I think the self-liquidation and contracting will help restore financial stability. And it's exactly the right thing these companies should be doing. It's just not happening as fast as I would like it.
Mark, we've also seen a number of companies exit Climate Action 100 Plus recently. What do you think that says about the market's view of the low carbon transition?
I think that Morgan Stanley did a study, I think just last week or 2 weeks ago, which said that there's a lot of investors and companies still really committed to incorporating climate change risks and moving towards a clean energy system. This study didn't say this, but this is my assessment of it, that they are not being so public about it. So the US administration's push back against sustainability and climate and ESG, just an unbearable risk for a lot of investors who just want to get on and do what they do best, which is managing money, looking at new data points to do their job better. And so the phenomenon of green hushy is happening, which is you carry on doing what you did before, but you just don't sing it from the rooftops, and you may withdraw from an initiative like whether it's Climate Action 100 or the Net Zero Investment Managers Alliance or whichever it might be, but it doesn't stop you from doing what you were doing before. And certainly I think that's what's happening. People are continuing to do this, but they're just not doing it in such a public way.
I have spoken with people who have said that there were players in the market who were really not all that committed, and that recent turn of events has given people cover to not only say that they're not doing that or pull out of things, but to also not do it because they were never really passionate about it in the first place. They were trying to get in on the action. You haven't seen that?
Well, some of the bigger players, they wanted to be in for the reason that lots of asset owners are members of the PRI. And one of the things about as a member of the PRI is that you incorporate key risk metrics around sustainability, including climate, into the RFP process, the request for proposals process. And so they need to be able to tick a box that says, of course, we're integrating all these risks. And of course, we try and ensure that we get the best information and knowledge on sustainability risks. So I think there has been some falling by the wayside. But what it does allow is fund managers that are really committed over the long term to ensuring the success of this. The cream flows to the top, and the market will be able to better differentiate between those, particularly the French and the British and the Danish and the Scandinavian funds. The Dutch are clearly way miles ahead of the also-rans. And you've got some pockets of strength in the East Coast and the West Coast of the US, but there's a bit more of a culture in the US, I think, of a fear of being sued. So, of course, people are not being so vocal.
Is there anything that needs to happen, though, to maintain momentum towards decarbonization when we're seeing a certain level of pushback? Or do you think ultimately this will make the market stronger because people who are committed are going to continue and things will continue to evolve in a positive way?
Look, the investment management industry are just intermediaries. They're just doing a job for other people. So the people that really count here are the asset owners, the insurance companies, the pension funds, the endowments. And if they all went quiet on this, then I think there would be a real problem. But we saw in the UK, the People's Pension Fund, they withdrew 28 billion from a large US listed fund manager because that fund manager drew away from climate related and sustainability related shareholder resolutions and knowledge building. And so they got fired. I think probably that's the market functioning. And the key to all of this is asset owners wanting it. And if you're a pension fund managing risks going out 50, 60 years, you need to be doing this properly. You need to be embedding climate risk if you're a long-term investor. And this is what the politicians don't really understand, is that the pension funds and their trustees and finance officers have a very different responsibility. They're not in a here today, gone tomorrow political administration. They're running assets over 20, 30, 40 years. So way beyond a single administration. So they've got to take the long-term view. And there I have confidence that the asset owners are holding firm.
In 2018, you expanded your work by launching Planet Tracker. And my understanding is that it applies the same stranded asset lens to oceans, agriculture, and food waste. Maybe you can tell me, how does that work complement Carbon Tracker's mission? And maybe give me some examples of stranded assets that you've identified.
In 2017, I was thinking about ecological boundaries. Do financial markets have boundaries in the same way that the planet has ecological boundaries? And of course, they don't. But it's not because we don't want them to, it's because no one has designed it yet. And I think about how do we ensure that the global financial architecture of marketplaces, particularly stock exchanges, bond markets, insurance markets, how can we get then to embed the idea of ecological boundaries? And because I look at companies, I look at what's on stock markets. I found a Chinese seafood company on the London Stock Exchange. And when I picked up their accounts, nothing about what they caught, where they caught it, whether the species were endangered or not, what their licenses were, how the boats operate in terms of their nets. And I thought, well, if there's one fishing company, there's bound to be more. So I was asking around my friends in the city and said, well, how many fishing companies do you think there are on the stock market? And they go, I don't know, 10, 20. And I thought, well, probably that doesn't, I bet you we're going to be surprised here. So I raised some money from 2 foundations and hired some people. And we discovered there's over 220 stock market listed seafood and fishing companies that have a market cap of $500 billion and they turn over $80 billion a year in seafood revenues. So not insignificant. And that's just the pure play aquaculture and seafood and fishery businesses. But once you add in the cannery companies and the food processing companies and the frozen food companies that are taking fish from the oceans and from these fishing companies, and then when you add in the hotel chains and the restaurant chains, I reckon about half of the world's fishing industry or seafood is going through stock market listed companies at one point or the other, these supermarkets in Taiwan and Indonesia and Japan and China. So there is a pathway to change the financial regulation for nature. Let's get these companies reporting on what fisheries they operate in, what what fish are they catching? What's a maximum sustainable yield? And is it certified? And what about the working conditions of people operating on the boats? And all these kinds of questions. And that led me to launch Fish Tracker, that then became Planet Track. And when somebody said, well, you got to do the same for food and ag. Oh, yeah, okay, all right. And now I want to do forestry and water. Then my colleagues set up Cooperatives looking at plastics in the oceans and plastics in nature. And textiles, which is a lot of textile companies on the stock market. There's a lot of waste in the textile space and a lot of recyclable materials. So that led me to launch Planet Tracker. And now we're in 2 different buildings, 2 different offices, 2 different teams. Now we're all part of one group now, and we're sort of leveraging off each other's expertise.
So is this under Carbon Tracker Initiative?
The parent company is called Tracker Group, but Tracker Group just owns the 2 teams, Carbon Tracker and Planet Tracker. And then the board makes sure that there's one board for both, and we just make sure that we're properly resourced for what we're doing on oceans and food. But a lot of people working in philanthropy don't think, when they think of the oceans and fisheries, they don't immediately go companies, and they don't immediately go investors. And of the 220, I don't think they mind me saying this, Vanguard owns 68 of those 220 seafood companies. But I was speaking to somebody there and said, oh, what do you make of your seafood companies? You got any portfolio? And they said, what seafood companies? Because of course, a company like Vanguard is going to have absolutely everything. These are tiny companies very often, and not all of them, but a lot of them are. And they're just not going to know what they own because, there's just too many of you to follow. So I thought maybe we can bring investors together. Maybe we can start challenging what these companies are doing in the natural world and change their fishing practices and so on. So that was the idea behind, but I wish I could persuade more philanthropy to do back this kind of work. But that's the kind of stuff that I'm interested in.
Looking forward, do you believe we can still meet the climate targets?
I'm an optimist. I think we've got all the technologies we need, particularly for electric vehicles, for battery storage, for offshore wind. And these technologies are getting more reliable. They're getting cheaper. They're becoming more efficient. We need to rebuild the grid pretty much globally to help electrify everything we do. We can move and cook in the heat using electricity, not using fossil fuels. But the question is, had we allowed ourselves enough time? And we should have started this 25, 30 years ago, but we got down some dead ends. But now we've got the technologies in place. We just need to scale. I think globally, the investment in fossils last year was just under $1 trillion, but renewables was over $2 trillion. It's a race against time. And with emissions of 40 gigatons of CO2, 45 gigatons a year, the carbon budget is running down really quickly. And unfortunately, that may mean that we will lock in major changes to the planet. The one we have to avoid, in my view, we have to avoid the close down of the amok, which is the circulating currents that bring warm water up to the north of the planet. Because if that closes down, the northern hemisphere will cool rather than warm up. And there'll be changes to where we produce food. 70% of the world's food production will be affected by one of these major changes. Then you've got other things, the dieback of the Amazon, the release of methane hydrates from underwater where methane's stored. There could be all kinds of cumulative effects, let alone the melting of the Arctic. So we enter a very dangerous time in human history. I bumped into an oil and gas executive who I got to know very high up in one of the major oil companies. And he had just retired and he said, Mark, we don't know each other too well, but one of the things he said, I told him, is that once we go through these changes in the next 10, 20 years, these are not reversible for tens of thousands of years. People think that once you've melted the Arctic, you just flick a switch and then it freezes again. Or when the Amazon dies back, you flick a switch and it goes back again. If we make these changes the next 10, 20 years, 30 years, which they will be irreversible for tens of thousands of years. And that's the consequences really of a lot of very bad decisions we've made in the last 15 years. Most of it political, some of it technological, some of it to do obviously with human nature and human greed. But I'm an optimist. That doesn't have to be the way. I think if we get to have a global agreement on fossil fuels, a fossil fuel non-proliferation treaty, with governments agreeing to the 17 countries now part of the process that will lead to an international agreement. If we cut capital investment into new fossil fuels, if we scale up investment in renewables, then we could have avoided the worst of it. But the interesting thing, Scott, I think we're older in years than a lot of people, but we will be young enough to see the consequences of the last 20. And they could be deeply unpleasant. I hope it's not, but it could be.
Explain the dynamic you referred to about if the water shuts down to warming.
So if you look at London, it's the same, around the planet. I forget if it's the latitude or longitude. I always get them confused. As Vladivostok in Russia. And we don't have the same weather system in London as we have in Vladivostok. And the reason for that is warm water is dragged up from the Gulf of Mexico and off the coast of Brazil is dragged up to the Northern Hemisphere. And it brings warm water and over Europe, particularly over the UK. And that allows the UK to have a nice, comfortable environment. But if through the melt of the Arctic, which forces lots of cold water down into the Atlantic and dilutes the salty water that allows cold water to recycle. So the warm water at the surface, the cold water underground, under the surface, will recycle and then return cooled water down south, and then which is then warmed up again. That yamok, that circulation of currents would be weakened, and it's already weakened by 15%. And if that continues to weaken and closes off, then the Northern Hemisphere goes into a cold spell. And actually, you would have colder weather. The scientists like Tim Lenton talk about London being minus 20 degrees Celsius in winter months. And of course, it never gets below freezing, really, most of the time. So you could have a very dramatic change in the Northern Hemisphere's ability to grow food. So scientists are following this very closely, and the warning signs at the moment, and you're seeing a loss of already the warming of the oceans, or up above plus 3 degrees, plus 4 degrees of warming the oceans. And these extreme weather events are changing the ability. Well, the reason why is the oceans has absorbed a lot of the carbon dioxide of the last 20, 30 years. They've reached saturation point. And this will now sit in the atmosphere. And when we talk about the atmosphere, and Al Gore is very good at talking about this, if you have an apple or an orange, the atmosphere is equivalent of the skin on an apple or the peel on an orange, very thin. And we're putting all of this carbon dioxide in a very thin atmosphere, thinking that it won't do anything. The oceans have done a great job absorbing the carbon dioxide, but now the oceans can't take up any more, and that will rapidly warm up the atmosphere. This is why we worry about going quickly to 2 degrees within 20 or so years, and then 3 degrees in maybe another 30. It'll be catastrophic. We've not seen this level of warming for millions of years. And where I am in London used to be a hot, steamy swamp. You dig below London and you've got alligators and tigers and lions. People don't realize the difference between freezing temperatures and boiling hot, unbearable summers is a matter of a few degrees. And we're playing around with nature in a way that, I don't think God intended us to do, but we're doing it now.
If you get cool to go down into the tube, I was there a few weeks ago. It's absolutely hot. It's steaming down there.
London was built for these hot temperatures.
In a worst case scenario, where warming limits are significantly exceeded, what do you think will be the broader impact on global economies?
I think we're going to get negative growth. So +2, if we have tipping points, growth will go into reverse. 3 degrees will seriously go into reverse, and the economy will decline. And we'll get real wealth destruction, loss of buildings and land assets. Manufacturing companies and cities are often built at sea level or below sea level sometimes, like the Netherlands. There could be a lot of flooding, which, all those manufacturers in Thailand and when they got flooded a few years ago, this was a write-off for a lot of these companies. So I think the consequences for the economy could be very bad. And then we'll see real wealth destruction. And then assets will then be derated and markets will reprice the value of assets. Banks will try and call in collateral, which will be worthless. And we'll have a problem in the banking system, and let alone the insurance market, which is trying to pay out the insurance of this. It's a pretty gloomy set of consequences, Scott.
Mark, you've been quite critical of the current state of ESG, and you've described it as overly complex and diluted by detailed tick boxing. If you could redesign the global sustainable finance framework from scratch, what would be your absolute core principles, and what would be your, let's say, maximum of 3 non-negotiable metrics to measure genuine corporate responsibility?
I would transfer. You see, what we do is we rate companies after they've listed, and then we moan about what the companies do after we've financed them. and then we try and change their corporate culture after they've IPO'd and we bought their shares. All of the sustainability should have been embedded into stock exchange listing rules, prospectus regulations, the role of the admissions panel. And all of these things should have been sorted out via the prospectuses and the accounts and the reporting against what you said you would do when you first raised your money and listed. I would be transferring the onus of responsibility to the listings authorities and the prospectus preparers and the standard setters and the accounting bodies. I would not have done a post hoc taxonomy of trying to sort out the goats from the sheep once companies had listed by naming, trying to brand certain companies and meeting this and coming with complex criteria and taxonomies after they've listed. I think we could, you see, if a company meets a criteria to be listed, you then put them into a particular cohort of companies with those characteristics that could vary. So you monitor it each year, but once they get their designation at the point that they list. So we need to change CEDAW codes and the kind of groupings of companies that exchanges have, like industrials, food and beverages and oil and gas and mining and stuff. I would change all of those and put a nature and 5 nature lens through it. That's what I would do, Scott.
That really only addresses, though, the public markets.
It doesn't address private markets, but I would try to do the same with private markets.
I've just got a few rapid fire questions. Can you describe an investment you made that ticked all your sustainability boxes?
What has been one of my favorite investments that I've been involved in? I really like the social impact litigation fund, Aristata, that I got involved in, litigating for people and planet. It's a strategy to back lawsuits for companies that don't treat employees well or for spoiling the environment. I think it's a really smart approach to investing that doesn't involve owning and buying and trading shares, but holds companies to account for what they do, but backed by private capital. That's been the most interesting investment I've been involved in recent years.
Have you been involved in any investment where you were very optimistic about it, ticked all your boxes, and it went pear-shaped? And what was the lesson learned from that?
It was a company called Ballard Power. It was a Canadian company that made hydrogen fuel cells for when cars were driven by hydrogen. Unfortunately, and it became a stock market darling. It was the Tesla of its day. Stock price shot through the roof. Only thing was, hydrogen didn't win. Electric vehicles won. I don't even know if it's still around, but it was a darling in the 90s and noughties. Where is it today? I have no idea.
Mark, you've been really generous with your time today, and it was great talking to you. I really appreciate it. I've learned a lot. Maybe you can just tell everyone what's the best way they can find out about all the great work you've got going on a Carbon Tracker and Planet Tracker. How can people follow what you're doing?
You can sign up to the newsletters at carbontracker.org. LinkedIn is very good. And then Planet Tracker also has news alerts. So planet-tracker.org or carbontracker.org.
So planettracker.org is also a separate site?
Yeah, so planet-tracker.org is a separate.
Planet-tracker.org.
Yeah, that's very good.
But Carbon Tracker is all one word, right?
Yeah.
Carbontracker.org, all one word. Okay, Mark, really, thanks again for coming on. I appreciate it. All right, goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.